Good morning, everybody, and welcome to financial year 2025 results presentation for Equites Property Fund. We welcome everybody online watching us today from beautiful Cape Town. Beautiful sunny day here, which ties in, I think, extremely well with the presentation we're about to give you today. I think we're going to start with maybe a little bit on the year in review, I think it's a powerful slide, this, in terms of what we've achieved in the last year, and really it resonates with what we've indicated to the market over the last 2 years of the intention of the business. So we continue to unlock world-class logistics facilities in SA, and in that vein we've completed a further 3.2 billion rand worth of facilities during the course of this financial year. We further committed to the fact when we sold out of our Newlands development platform in the UK that the development activity in the UK basically is a part of our past, if you like, and in that process we are working through the extraction of our value in the remaining parcels of land in which we still have an interest. We obviously want to do that in an orderly way, and would like to sell off the pieces, and we'll talk to that in a bit more detail as we go through the presentation. Further to that, and I think Rian will talk to it in a lot more detail later in the presentation, we've implemented a very strategic sell program, and this was a consequence of two things. Firstly, that we had this significant development pipeline which we don't foresee sort of slowing down. It'll have very, very good years, and it will have some good years. I don't think we'll ever see not so good years. I think the future looks well. We also committed to making sure that our balance sheet always remained strong, and in so doing, we found the opportunity over the last 2 years to undergo a sales program of selling assets that firstly were non-core, but secondly, some of the assets that maybe were a little bit older, still had some good meat on the bone, and the consequence of which is we got some really good pricing, and again, as I said, Rian will talk to the detail of that in a little bit in the presentation. Following on from that, I think it talks to the high caliber portfolio that we own. We've had 4 leases renewed during the last financial year, and 2 buildings where the tenant didn't renew, and we've managed to re-let them in the year. What was obviously extremely pleasing to us was the fact that the reversion that we were expecting in the renewal program with the existing tenants ended up being significantly less, and hats off to the asset management team that did a great job in those negotiations, and we only saw a 9% down on that. Again, then tying into the strategic sales that we spoke about, you can see that we've been talking about a flight path to trying to get as close to 35% as possible, with the ability to fluctuate between 35 and 40. But as you can see, the balance sheet obviously in really, really good shape, down to 36% loan to value, and also I think to be taken into great consideration, ICR of 2.3, which as a consequence of all the ShopRite developments that will start rendering income now for the next 20 years, we should see that ICR number get significantly better, and Warren will talk to that in a bit more detail later in the presentation. The final element, obviously, which is hats off, is to Leila and the finance team, obviously, is we've managed to reduce the cost of debt. And what's amazing about the organization is that the symbiosis between one thing happening and the consequence affecting a different part of the organization. And I think this is a classic example of that. We have an underlying incredible portfolio which is fully let to blue chip tenants, yielding us great returns. And the consequence of that is the debt capital markets obviously have seen that, and we've seen the debt margin obviously come off significantly, and I think putting us in a position of great envy to the rest of the market in terms of where we sit there. In the UK, obviously nothing has changed. everything was fully hedged, and obviously we've added nothing to the portfolio. So that's remained exactly the same. Just to now go, obviously, I suppose the most important metric that everybody's sitting in, and I'm sure you probably already all paged to this page and have sort of, and that big number on the left. And obviously, we're really pleased that DPS has shown a 2.1% growth at 133.92. And obviously, what it does show is that the portfolio has fully stabilized now, and we are expecting some great things in the years to come. And the rest of the presentation in various parts of it will talk to that. I think over the last 2 years, the rumour mill has been massive around Equites and this payout ratio. We continue to maintain a 100% payout ratio, and as we've said on numerous occasions, we will inform the market with massive lead time should that decision be changed by our board. But as things stand at the moment, we are committed to that 100% payout ratio, and we know that for a lot of our shareholders that is quite an important metric. Again, the loan to value at 36%, obviously very pleasing, and we'll see how that plays out later in the presentation, where that is obviously linked not only to the sales program but also to some of the revaluations that we've managed to achieve through the portfolio. And then the final element, which is also pleasing, at 16.49, the NAV per share, and this is notwithstanding the fact that we took a significant write-down in the ENGL transaction. The expectation is, as we trade out of the rest of the ENGL platform over the next 18 months, the expectation is that some of that write-down will probably get written back up if we are successful in executing on some of the things that we have in our pipeline at the moment in terms of that disposal. Over and above that, obviously, from financial year 24 to 25, the rand also sort of performed significantly better. So that exchange rate number obviously also had a bearing. And then the final element that had a bearing on that obviously would have been the DRIP program that we undertook during the course of last year, which would have been slightly dilutive to NAV as well. But all in all, really pleased with that number. Vacancy remains in South Africa at 0%. In the UK, we've got a very small unit adjacent to the DHL in Reading, which is vacant. Obviously, it is a vacancy, so it needs to be reflected, and it's there. It was let on a short-term basis last year. Unfortunately, that tenant has vacated the premises. Property portfolio, obviously like-for-like growth in the portfolio in SA was really good, at 6%, and in the UK, the portfolio was more or less flat, slightly up in pounds, but obviously that offset by the rand appreciation in the period. Notwithstanding that, really pleased, notwithstanding the sales program as well, that the portfolio is still a robust 27.7 billion. We've already talked about the developments, and after a financial year of 3.7 billion of developments, to follow that up with 3.2 billion, I can assure you that it won't be that kind of number in financial year 26, but notwithstanding that, it will still be a significant number. Very pleasing here that the WALE has risen again. The one thing about WALE, obviously, is that every year that goes by, it automatically does come down. The one thing that none of us can stop is time, and we'll see that the development program, what it gave us, and the consequence of which it fed through into the whole portfolio, and obviously increasing from 12.6 to 14 years. And then the final element, obviously, is our solar number. It's an important metric for us, especially in a world where we do have quite a lot of sun in South Africa, and where we can harness it and provide our tenants with a mitigation when it comes to energy in the building. But notwithstanding that, we can also sometimes provide them, obviously, with certain costing efficiencies as well as a consequence. What's pleasing is that we've increased the number of buildings with PV on the roof from 29 to 37. We currently have, I stand to be corrected, I think 62 buildings in the portfolio. So we continue to march towards that process of one day having all our buildings with solar on them. The other important metric on solar is that I think in financial year 26, we'll start seeing solar actually making a meaningful contribution to DPS as well, and that hopefully will grow proportionally over time. Operating market. So SA, continues to surprise in the positive. The logistics sector at very low vacancy levels of 2.1. Obviously, Equites in South Africa is 100% let. We are of the opinion, though, at the top end of the market, which is the market in which we generally operate, that vacancy factor is probably somewhere in and around maybe below 1%, which obviously bodes very well for the sector. The sector obviously remains the most favoured sector within the property spectrum. I think not just in South Africa, I think globally, and that can be seen in the yields being achieved for these properties. And Riaan, will talk to some of the yields that have been achieved in our sales program, which are industry leading, but I think reflective of the sector and the quality of buildings that Equites is sort of involved in. Rental growth still very much there. There's a combination, obviously, of scarcity of product, scarcity of new land coming on board, and coupled with that also we do have some construction cost inflation that has come through in the last sort of 18 to 24 months. And whilst it's not crazy inflation numbers within the construction industry, it is not, nonetheless, it is there and needs to be taken into account. And as we know, developers in South Africa, would need to make a return on their investment to warrant taking a scheme forward. So what we're seeing is over the last sort of 4 or 5 years is we've seen rentals grow by approximately 23% to what we would call the pre-pandemic levels. Most of what Equites has done in the last 24 months has been pre-let. I think the market generally is also very much in pre-let mode. What that has done is reduce the amount of speculative developments that are coming online. And as a consequence of that, the supply side being obviously dented has resulted in demand side still being there. And that demand side obviously then supports that rental growth story. In terms of the operating market, I think this is actually a very powerful slide. I think, supply chain very much at the essence of what Equites is about. We provide a real estate solution to operators in the world that need to get goods to the end consumer. And we are just one cog in that, but a very, very important cog, because bottlenecks happen as a consequence of poor real estate. You can't mitigate against poor real estate in supply chain, and we see this illustratively extremely well in this graph here, where you'll see that the consequence of TFG taking up the Riverfield space up in Gauteng has seen their replenished lead time to get stock from DC to store from 4.6 days to 2.6 days, which is a massive 43% saving in time. Now, ultimately, those 2 days could be 2 days where you could have a whole host of customers that walk in and the stock is not on the shelf, and the consequence of which there's a sale that's been lost out. So, and obviously that directly translates into the next side of the slide, which obviously makes the availability go up from 84.9 to 91, which is an 8% increase. And the number 8% seems small, but it, when you're approaching the 100%, every little increase incrementally is absolutely massive. And when you're talking about an organization like TFG that's got in excess of 3,000 stores across the country, you can imagine what the multiplier effect is on that. E-commerce remains extremely important in SA and continues to grow. The estimate for this calendar year is that the growth from 150 to 225 billion, and ultimately, I speak for myself here. If I go online and I want to buy something, if it's unavailable, it's very, very frustrating. And in order for, or if I put in my order and it tells me it'll only deliver in a week, or it's very frustrating. And what you'll find is that the online pages that can afford, speedy delivery and consequential availability will see the greatest growth. And we're seeing that across the board, that these various organizations are becoming better and better at it. They're learning every year. They're learning from, I say, past mistakes, but also from past successes and wins, and building on those. Coupled with that, we've got a country that sees urbanization continue to happen, and as a consequence, urbanization obviously is e-commerce's best friend, and getting stock to the rural areas remains, I suppose, the biggest challenge to e-commerce. The urban model obviously works extremely well. It allows obviously time to delivery to be reduced greatly. Now, ultimately, in order for all of this to tie in, one needs land. If you don't have land, you can't build the building. And ultimately, having available land in key nodes, which is serviced, i.e. it's got electricity and water and sewage available to it, is becoming a challenge in South Africa. There's no question that the infrastructure backlogs at municipal level across the board, and availability of land which can be rezoned, and the processes of rezoning are becoming more and more complex as years go by, and that is a consequence that is impacting the total availability, and hence land becoming that much more valuable. But I think more importantly, it's putting pressure on land pricing as well, which ultimately is going to ultimately put pressure on rental growth as well. In the UK, I just wanted to sort of spend a bit of time here, and we'll talk a bit more detail about what's going on in the UK later, in terms of the Equites portfolio and what our thinking is. But you can see that the take-up levels have sort of more or less stabilized to pre-COVID levels, with 22.6 million take-up in the previous year. And the expectation is that this year will probably be something very similar, and demand actually normalizing. Annual increase in rental, still a healthy 4.4%. However, we are expecting that to trend closer towards inflation over the next couple of years. I think what's keeping it there at the moment, obviously, is speculative building has certainly been reduced greatly in the UK. The consequence of which is that there's very little new stock coming to market unless it's pre-let. But where we've seen availability rates rise is very much in second-hand stock, which is being returned to market rather than through new speculative developments. I think what's fantastic about the UK market, which I think sets it apart from many markets in the world, is its deep liquidity. It's incredible that a market like the UK has got such massive pools of capital that are looking to be deployed. However, the UK market has got a history of being intrinsically linked to that UK 10-year gilt curve. And although we're seeing the base rate come off in recent months, we're not seeing that feed through into the longer dated UK gilt. And ultimately, as soon as we start seeing that, I think we'll start seeing the prime yields sort of going into the fours. At the moment, I would say they're probably sitting between 5 and 5.25%, obviously depending on location, covenant, longevity of lease, and various other things. But that really is where the UK sits at the moment. In terms of development, as you can see, another groundbreaking year for us. Great to have entered into a provision of a warehouse to the SPAR Group, and we hope it's the first of many to come. We've fostered a great relationship with the management team there, and the consequence of this particular facility has already seen significant improvements in the efficiency of the Encore stable within SPAR, which is really pleasing to see, because it really does help us sell the supply chain dream within the senior management team and the board at SPAR, which hopefully will lead to some great business going forward. We completed the upgrade to the ShopRite in Centurion. Now, obviously, that is the nerve center of ShopRite's business up in the north, and an absolutely vital facility to ShopRite's ongoing success, and also great to see that ShopRite willing to spend sort of just shy of 200 million in upgrading that facility to ensure that it remains relevant within their portfolio for many, many, many years to come. In Quebec, we completed the Wells Estate facility, absolutely fantastic facility. What it also does is, for the first time, it actually opens up the Eastern Cape for the Shoprite Group, and we are expecting a pretty aggressive rollout of stores probably for the group in that region going forward as a consequence of this, as the lead times to getting stock into stores obviously greatly reduced, and the availability of stock now obviously meeting Shoprite requirements in terms of where they are as an organization. So really pleased to be part of that, and obviously very pleased to be investing in a region that certainly needs as much investment as possible. So we look forward to potentially doing more deals in that region of South Africa. Watch this space, as they say. In Gauteng, obviously, again with the Shoprite team, we've done the Riverfields development. This particular one is not in our joint venture partnership. Equites owns 100% of it, and it's obviously in a park together with the TFG facility adjacent to it, and obviously a world-class park which will be a bedrock of Equites' portfolio for many, many, many years to come. During the year, we did 3 speculative developments. 2 of them were let prior to PC and 1 shortly thereafter. What's really pleasing is that the tenant that moved into the facility, one of the facilities, has given us indication that 6 months after sort of being in the facility, they've already noticed about a 45% improvement in their efficiency targets in terms of their business, which obviously is incredible. What it does is, again, it reinforces this story that if you can get supply chain right, and you get the correct real estate solution to provide that, it is a game changer for your business. And then I think the final part of this slide that I sort of want to talk to, obviously, we've put 18 years there, obviously in red, so you don't miss it. And really, this really talks to what Equites is about. It's about creating sustained, long-term income for our shareholders, and this can be achieved by creating world-class facilities for world-class organizations on long-term leases. And you can see that 18 years, over 220,000 square meters of GLA is absolutely incredible business for us and for the organization going forward. So super proud of that number and what it means to us as an organization. I'm going to hand over to Riaan now, and he's going to take us through the highlights. And I think highlights this year, it's been a fantastic year, and well done to him and his team.
Thank you very much, Andrea. This year has certainly operationally been the busiest year we've ever had, with a lot of focus on asset management. As you can see from the slide, our property fundamentals remain impeccable, and it's probably the reason for our sustained and predictable income growth. At 14 years, a weighted average lease expiry profile gives us that certainty, and then 98% of our tenants are A-grade tenants, so it means multinational listed companies, which shows the very low risk of our portfolio. We now have 1.6 million square meters under management, and there'll be 2 separate slides on our like-for-like rental growth as well as our like-for-like valuation increase over the past year, both in the region of 6%, and we're very pleased about that. And at year end, you'll see that there's 960 million rand of assets held for sale, comprising 2 specialized facilities and the remainder some of the UK properties. Looking at the like-for-like growth of 6%, I think this was driven through the sustained rental growth that we've seen over the past 3 years. The main reason for this rental growth, which is very pleasing, is firstly, as Andrea indicated, there's a very low supply availability of A-grade logistic facilities. And then secondly, tenants are more and more realizing the operational and financial benefits that can be derived from operating in an A-grade logistic facility in a secure park. You'll see on the right-hand side the rental growth at our Meadowview and Waterfall facilities were slightly lower. That was as a result of these portfolios being acquired in 2015 and 2016 respectively, and over the course of 10-year leases with an average escalation of 7.5% and the underlying market rental growth of circa 5%, it can be expected that there would be a slight reversion. We had 6 leases that came to an end over the past financial year. 4 of these leases were renewed at an average reversion of 9%, at a total of 110 rand a square meter, and in 2 facilities the tenants vacated and we replaced them with new tenants where the renewal rental was a pleasing 101 rand per square meter. Looking at the like-for-like valuation growth, again 6%, which is very pleasing. This was influenced by our disposal program where we achieved better than expected pricing, and also the contractual rental renewals at rents which were superior to the market rentals that were used in the prior years for the valuation purposes. As you can see there on the right hand side, we've also broken down the rental growth, the valuation growth in respect of the various parks we have and also the Western Cape. The Western Cape is booming property-wise, as you will know, and we've seen good demand for our facilities, and it bodes well going forward. A key time for us is when leases come to an end. We see our tenants at least twice a year, and during these engagements we familiarize ourselves with their business, whether the facility is suitable for their needs, whether there's an opportunity at lease renewal to enhance, improve the facility, and also it's a time to talk about ESG in exchange for a renewal. I have mentioned that we've renewed the 4 leases and we replaced the other 2 tenants in the facilities, and on the right hand side you can see the 4 renewals with existing facilities and also the details on the rate per square meter, which averages at 110 rand a square meter. Now, a couple of years ago, if we had talked about 110 rand a square meter, it would not be credible, but we've just seen over the past 3 years that rentals have grown significantly, and we expect the growth to be sustainable, also because we see a very little speculative activity in the market, and our speculative program has been very successful as a result, so we can expect this growth to sustain. Andrea referred to our disposal program. As we've mentioned in the past, we apply strict criteria when it comes to identifying properties for disposal, and we've listed them there. Obviously, a disposal program is also an opportunity to strengthen the fundamentals of our portfolio by selling the slightly older ones and making sure that ultimately our aim is to have a portfolio that is green in all senses and has all the bells and whistles of proper ESG compliant facilities. You will note there that since FY23, our disposal program has been implemented to sell 6.8 billion rand of properties, of which 2.4 billion was concluded and transferred in the current year. 4 of the disposals were done through Statement 102 transactions. Those are BE transactions, and we're very pleased also to play our role in the transformation process of our country. On the right-hand side, you will see the individual disposals, and those are the contracts that we signed during this financial year, amounting to 1.4 billion rand in South Africa at a value uplift of 1%. We've also received significant offers in respect of other assets in our portfolio at yields superior to our valuations, but ultimately our business is retaining and building our portfolio, but we will make use of these strategic opportunities if it's opportune and at the right time. In the UK, you'll see the one disposal, Amazon Peterborough, was done slightly below book at £38.5 million. That's all from my side, and I think it's over to Leila now.
Thank you, Rian. Okay, so They say that good news is easy to tell, so I hope that this will be an easier story to tell. But I think let's start with, as Andrea said, the metric that's most important to a lot of investors, and that's our distribution per share. So for FY25, our distribution per share is 133.92 cents per share at the upper end of our guidance, which reflects a 2.1% growth over FY24. The NAV per share is 16.49, down from FY24, but the major driver for the decrease in NAV is the ENGL transaction, as well as some FX movements, which we'll talk about in a little bit more detail in the upcoming slides. The LTV, I'm going to pause here for a moment because in FY23, I remember sitting here and saying we're reporting an LTV of 39.7% and we've got a flight path to reduce this LTV over time. In FY24, we spent 3.7 billion Rand on acquisitions and developments. And when we reported our FY24 results, our LTV was 39.6%. In FY25, we spent 1.5 billion Rand on actual capex and development spend. But due to the successful disposal program, as well as some valuation uplifts, we've managed to reduce this LTV to 36%, which is really where we're very comfortable with this LTV. But I think it encapsulates a lot of what both Andrea and Riaan have spoken to about how we've been very focused and disciplined in our disposal program and using those proceeds to reduce our LTV. Importantly, we also have 2.9 billion in cash and undrawn facilities, and Warren will take you through a little bit of our strategy around why we have these undrawn facilities. And then lastly, and this is not a material number yet, but we did communicate a strategy whereby we'd focus on alternative sources of revenue. And for the first time, we actually have revenue from solar projects and from PPAs which we've signed, which is included in the revenue for FY25. Now, this number is less than 10 million Rand, but we do expect it to be a growing number going forward. Okay, so if we move on to the next slide, and we talk about our financial position, I think the first point is really important. 6% increase in valuations of the SA income producing portfolio. Now, what gave rise to this 6% increase? I think the first thing is that with the disposal program, we really managed to recycle out of older, non-core, non-ESG compliant assets and deploy the money into brand new, long-dated, ESG compliant products. And this helps us from a valuation perspective. For example, the ShopRite assets, it's a very easy discussion. They're on 20-year leases, and you know that you're almost guaranteed uplifts every year. Secondly, what really helped our valuations this year was market rental evidence. Now, Riaan spoke to signing new leases at 101 Rand or 110 Rand, and that really underpins the market rental evidence, which helps to support the valuation growth year on year. And I think that where this all comes together, and you can finally see it, is that overall increase of 6% in the SA portfolio. Now, the UK assets remain stable. Andrea spoke to how there's been a dislocation between the base rate and gilts. So even though the base rate has decreased by 75 basis points over FY25, we haven't seen the commensurate increase in gilts, and therefore the UK valuations have been reasonably stable. Now, underlying our entire balance sheet is really the investment property. And if you look at it year on year, the investment properties decreased by 730 million Rand. Despite the 1.5 billion Rand which we've spent and the valuation uplifts in the portfolio, this was offset by the 2.4 billion Rands worth of disposals and FX movements over the period. Now, I just want to go back because I said that there's a 6% increase in the SA portfolio, but you're only seeing valuation uplifts of 140 million Rand. If you look at our detailed investment property note, you'll see that a lot of the write-off related to the ENGL transaction actually goes to that fair value uplift line, and that detracted from the SA valuations which we did see. Okay, held for sale, in line with our disposal program, which was still underway and we were still in the middle of it, I would say, at FY24. There was a 2.1 or 2.2 billion Rand held for sale balance at FY24. We disposed of 1.4 billion Rand of SA assets, 1 billion Rand of UK assets, and at year end, FY25, we only have a balance of 960 million Rand. The majority of this relates to the UK, 2 income producing properties in the UK, some land in the UK, and then 2 SA properties, 1 which actually transferred yesterday. So that sort of makes up the balance, and I think for the most part, as Riaan said, this sort of sees the conclusion of the SA disposal program. The increase in cash, there was a massive increase in cash year on year. This was driven by the disposal program, but also at year end, there were a number of disposals which happened almost in the last week of the financial year, and this increased the cash on balance sheet at year end. And then the disposals, as we spoke about, resulted in an 11.2% decrease in net borrowings. The cash received from the disposals were used to repay debt facilities as far as possible, or to invest in money market type products, and as required for developments, we will draw down on these facilities. Okay, so now the distribution statement. We saw net property related income grow by 6%. This is supported predominantly by the like-for-like rental growth in the portfolio of 5.9%, as well as rent reviews in the UK. So we had DHL Reading, DPD Burgess Hill and Puma, which all experienced rent reviews during the period. I'll touch on these a little bit more in the bridge. The net property related income was slightly offset by brief vacancies during the period. There was a brief vacancy at the Paro spec facility, which is now let, as well as the Meadowview spec facility, which is also let. Now, increased net overheads are driven by a few items. There was a large increase in UK admin and legal costs as we were gearing up for the disposal of the ENGL platform, as well as the level of development activity had decreased massively. As I said, we spent 3.7 billion rand in the prior year, we spent 1.5 billion rand in the current year, and therefore the capitalization percentage has decreased year on year. So if you look at the capitalized percentage or capitalization percentage of overheads, it was 28% in the prior year, it's 23% now, and we expect this to be a more normalized level in line with the level of development activities. What's also important is that, and Andrea will talk to the disposal of, or the potential disposal of the UK platform, but included in net admin costs is 32 million rand relating to the UK income producing portfolio, which we haven't added back for the purposes of distributable income, so it's included in that number. And where we expect admin costs to stabilize is probably around 100 million rand per annum. Included in the distribution statement is an antecedent dividend. This relates to the impact of the 2 dividend reinvestment programs. We raised about 700 million rand over the year in 2 really well subscribed dividend reinvestment programs, and that gave rise to this antecedent dividend. Over the period, there was a reduction in the cost of debt, which enabled us to replace maturing debt with lower costing facilities, which Warren will talk about. We're incredibly proud of our success in the DMTN market. This was slightly offset by a reduction in borrowing costs capitalized. Now, I just want to pause here for a moment because we get a lot of questions about this. In the prior year, we capitalized 444 million rand to developments. In the current year, we capitalized 331 million rand, or 333 million rand, sorry, to developments. I want to break that down even further. When I look at that number, I think the part that gets questioned the most is really the land. And I'm going to start off by first saying that included in this number was still all the ENGL sites for the period until the transfer happened. So there was some of that included in this number. If we want to talk more detail, 77 million rand of that total number relates to trading property, of which 57 million rand relates to Basingstoke. We expect that will be the balance that doesn't relate to Basingstoke is now out of the system. The Basingstoke balance, Andrea will give some colour to when he discusses our strategy in the UK, but again, we expect this to probably be disposed of in the next 18 to 24 months. We spent 80 million rand of the capitalised interest balance relates to land, of which half relates to UK land. Again, this is part of the ENGL transaction, and we expect this to reduce in FY26. The remainder relates to South African land parcels. included in all our South African land parcels are 2 land parcels which we're no longer capitalizing interest on. So we've always communicated that we are very prudent in our capitalization approach on land. Where there are no current development activities, we cease capitalization on those land parcels. Okay, and then the remainder and the majority relates to SA developments, and as we've always said, this will be a part of our ongoing business, and we always expect to have capitalized interest relating to developments, which rolls off and becomes income generating. Okay, then the increase in, or the non-controlling interest, as you know, we have a massive non-controlling interest relating to RLF. If you look at it at the face of it, it appears as though the number hasn't increased much, even though we've brought online all of these developments. I think what's important to note is that we all know that these developments are dilutive in year 1. So the finance cost, if it's funded 100% through debt, is going to exceed the cost of rent. And that's why we haven't seen a massive increase in the NCI relating to RLF, despite more developments coming online. Okay, so our DPS bridge, again, I think I've spoken through the majority of these items, but just to pause, like-for-like rental growth in SA of 5.9% contributed the majority of the DPS growth, so 4.9 cents to DPS growth. And then in the UK, we had those rent reviews, which we spoke about, which contributed 2.5 cents to DPS growth. The positive rent reviews, Andrea usually talks about this, but DPD Burgess Hill, 69%, DHL Reading, 28%, and Puma, 42%. So I think overwhelmingly positive. In the upcoming year, we do have DHL Reading, which is expecting a rent review, and then the only remaining asset in the income-producing portfolio will be Every, which is still subject to a rent review. Okay. Then if you just look at some of the detractors, as I said, there was periods of brief vacancy during the period relating to speculative developments at Meadowview and Parow, which detracted from DPS. There was some dilution from the ShopRite developments, which came online in the back end of this year. And then the net overheads, which I've spoken about now, was also a detractor to DPS. There were some tax consequences, a very small amount. If you recall, in the prior year, we did have some tax leakage, so not having that was improved DPS. And then Newport Pagnell had a significant financing component. As we discussed last year, we concluded agreements, or concluded successful agreements with Panattoni to deliver the scheme. Because the consideration or the final check is only expected in November this year, there was a significant financing component which increased DPS. In November, we expect to receive the final check, and that will be invested or used to repay debt, which will then offset the financing component included in this transaction. And then tightening in debt margins or credit spreads contributed 3.1 cents to DPS. And then lastly, the DRIP had a dilutionary impact of 1.1 cents. Okay. And then lastly, just the NAV bridge. Again, I'm not going to touch on every element here, but just the SA portfolio and the valuation increase we saw there was the largest contributor to the increase in NAV per share. But then we had several detractors from NAV per share, and I'm going to lump a few of them together. If we talk about the ENGL transaction, we wrote off all capitalized costs relating to the sites which were actually disposed of, what we call the initial sale companies. That resulted in a write-down in that ENGL segment. We also, in the developments or the developer segment, there were certain sites relating to that ENGL transaction, which we also wrote off all the capitalized costs. And we either disposed of them or we expect to dispose of them by 30 June 2025. And then lastly, just the remainder of the ENGL transaction really relates to the deferred consideration, which we expect to receive as a result of profits, or Newlands making profits on the remainder of the sites. So included on the balance sheet, when you really look at it, we have taken everything down to cost or net realizable value. All the remaining land options are carried at cost or net realizable value, i.e. the value we expect to receive for it. And if there is any upside on any of these transactions, that will all be upside to the balance sheet, which will come in subsequent years. And we really have taken the full or incorporated the full impact in the NAV in the current year, in FY25. And then I think you know, the FX, we really are at mercy to the currency. The rand did really well at FY25, and I'm smiling because it did really poorly after that, but we capture it at a point in time, and the improvement in the exchange rate actually had a detraction from NAV of 24 cents, and then the drip again was dilutionary because we issued these shares at a discount to NAV, and that takes us to our 16.49. So I think that's it from me. We had a remarkable year from a treasury perspective, and I'm going to hand over to Warren to take you through some of those highlights.
Thank you, Leila. We've heard from my three colleagues around this certainty that who we are as a business, what we do, and our results. And we run treasury and risk management with the same focus and approach, and that's to provide that certainty year on year. This is no more clearly evident than in the debt capital markets, and I'll come to an analysis of that. First, let's have a look at LTV, and my colleagues have spoken through a number of the items here, but to touch on the three main points there, the disposals that we undertook in both South Africa and the UK, cumulatively 2.4 billion, that reduced LTV by almost 5 percentage points. The developments that we undertook in South Africa, of which roughly half were for Shoprite, that increased the LTV by 3.8%. And then lastly, the drips that we offered in June and November last year, that was taken up by almost 2/3 of our shareholders. That provided us with 700 million of equity, and that reduced our LTV ratio by almost 2.5%. And that brought us to the 36.0 exactly at the end of February 25. So that creates headroom on both sides for us, which is a great position to be in as a business from a balance sheet perspective. We've heard a lot of talk about the cost of debt, and I'm going to show a very interesting slide here. On the right-hand side, it may be a little confusing at first, so I'm going to break it down for you. Those bars that you see are the volume or the quantity of debt in each of the last 3 reporting periods. So that's from August 23 all the way through to February 25. So there's writing at the bottom of each of those bars, and that refers to the duration of that debt that either matured or was refinanced. So for example, on the left-hand side, the second half of 2024, you will see that there was 2.7 years being the duration of the debt that matured. What was then refinanced during that same period was 3.5 years. And you can see for those 3 reporting periods, we extended the duration of the debt for each of those periods. Notwithstanding that, we managed to reduce the cost of our debt, or the spread above 3-month JIBAR, by approximately 30 basis points. So for example, on the far right-hand side, the most recent of those reporting periods, we reduced the cost of debt from 156 basis points above 3-month JIBAR all the way down to 128 basis points. This just gives an alternative view of the cost of debt. On the left-hand side, the last 4 years, how that cost of debt has reduced from August 23 down to where we are now in February 25. Now, notwithstanding the fact that the reference rates, 3-month JIBAR and SONIA in the UK, have come down, I do draw your attention to the fact that we are 83% hedged, and I'll touch on that in a bit more detail later. On the right-hand slide, we've spoken about how well we have done in the debt capital markets. And that graph shows the last 5 years since we launched our DMTN program in February 20, all the way through to where we currently are. On the far right-hand side of that right-hand graph reflects our auction in November last year, where we raised 3-year funding at a spread of 110 basis points, and 5-year funding at a spread of 125 basis points. Now, these levels are the lowest in our sector. We also raised 1-year funding at 92.5 basis points through a private placement, also in November last year. Right, some of the key aspects are on this slide. I'm not going to go through all of them. Leila did mention the 2.9 billion that we have in cash and undrawn facilities. And this is a key fundamental of the focus and risk management we take to Treasury. So that liquidity that we have in our business allows us to ride out market dislocation periods. For example, in June last year, we had the national elections. That liquidity that we have allowed us to postpone that auction for a month until there was more certainty in the market. And then that auction that we had in July last year was very successful. Our interest coverage ratio, as we've said, has increased to 2.3 times. So that's revenue over cost of debt. And that's a factor of both the developments coming online and increasing our revenue, as well as the cost of debt decreasing. And as Andrea said, we foresee that increasing significantly in the future. Our weighted average debt maturity 3 years ago in Feb 22 was 2.7 years. And that has sustainably increased over the last 3 years to where we are now at 3.8 years. Our property assets that are not encumbered, so that's where we haven't provided them as security to bilateral lenders, those unsecured properties comprise about 60%, so 62% of our total assets. And that gives our unsecured investors, so typically those 26 non-bank financial institutions that participate in our debt auctions, that comfort that there is significant headroom in terms of security of assets. Lastly, then, in terms of those secured ratios, our balance between secured and unsecured debt is half-half, or 50% each way, and we like to keep it around that level. I did speak earlier about the amount of debt that is hedged, so 83.4%. Just to illuminate that a little bit, that refers specifically to debt that is over 1 year in maturity, so about 8 billion of our debt, 9.5 billion of our debt, and 8 billion of interest rate hedges that have more than 1 year to maturity. And that, again, gives certainty to our business. So all of this, as I've said at the beginning, provides certainty from a financial risk management perspective, and that feeds into the certainty and stability of the business. And without that, or with that, as investors, it provides you with the certainty to invest in our business. I'm going to hand over to Andrea.
Awesome. Thank you, Warren. In sort of coming up, concluding and winding up the presentation, obviously the sustainability and transformation remain a very integral and important part of the Equites way. You'll see our solar capacity in the period has grown significantly from 20.2 megawatts to 26.7. And I think what this talks to, it talks to the fact that we continue to invest in this capacity, but for two reasons. Obviously, the sustainability issues remain important, but as we all know, the availability issues within the South African marketplace remain a concern for our tenants, and having this as an opportunity for our clients is extremely important. We obviously achieved the first IFC Edge net zero carbon building, and we have 2 further that are currently in determination, and hopefully we'll be able to announce those during the course of next year when we present these results. Within the portfolio, obviously the portfolio has got about 703,000 square meters of it effectively certified, with another 243 coming online, which is approximately 60% of our portfolio being green certified. I think the Wheeling project is another project which obviously we're extremely proud of, that we were included in the process by the City of Cape Town. We provided the green energy to the building. We actually are tenants in here in the town centre, and we hope to be able to grow this part of our business substantially over the coming years. We have the potential of about 730,000 square meters of roof space available to us, which is pointing in the right direction towards the sun, which hopefully we will be able to exploit in due course. The final element, which is one maybe that doesn't really yet achieve as much attention as the solar stuff, is the water stuff. And as you know, especially our Gauteng clients have had significant water issues in the last 12 to 24 months. We foresee these issues to potentially get slightly worse over the coming periods. And as a consequence, we are looking at integrated biological wastewater treatment plants. What will that do? That will afford us the opportunity to be able to use treated water for everything that is non-potable. Now, that accounts for, within our facilities, normally approximately 75% of the water consumption in a facility, thereby greatly reducing the quantity of water that will be used, or potable water that will be used by our clients, thereby increasing the available water to the rest of the communities in which we reside in. I think around sustainability, obviously, it remains a politically fairly highly charged issue. And as we can see with current, let's say, political leanings in the world, it seems to be aiming in a direction which is less important. I think this may change several times over the next decade in terms of as things do play out, and we will have some pro and some against. Ultimately, I think from an Equites point of view, we committed to what we're doing because we feel it also enhances the product that we afford our clients within the compact of operating in a South African environment. And I think we need to take that into consideration. We need Plan B available to our clients. So it is a double-edged sword for a lot of things. We feel it's the right thing to do, but it's a necessary thing to do within the context of a South African marketplace. In terms of social transformation, obviously really pleased that we've managed to achieve level 2, a very high level of black ownership. And I think Rian spoke to the Statement 102 transactions. We've done a few more this year, but in total, in our history, we've done 7. And I think this really talks to us really trying to, where possible, without obviously eroding shareholder value, bring in black entrepreneurs into the process of property ownership, and also the transmission of that skill in terms of property management, asset management, and relationship building with financial institutions to enhance return metrics for and the success ratios for these new entrants into the marketplace. Very important part of what Equites does, a commitment to education in the country. We were very committed to this process and have had several successes with interns in the employment of the company, but also by giving internships to people that have gone on and are working for world-class organizations all over the globe at the moment. So really proud of that. I think a great initiative was created by 2 members of staff that came through our internship program and felt that whilst they were at university, they learned a lot about property, but they had no idea what a REIT actually, what it encapsulated. And so we've created this 1-week intensive course, one in Cape Town, one in Joburg. We normally have between 8 and 10 students, and what they do is they get exposure to every aspect of the business. So from treasury to developments to property management to billings to new business, the whole work. So they get a real good insight into what being a REIT is all about. We've also had 44 students that have gone through this participation of our working programs in the system. The final part of it within the education system, obviously, which is great, is we've effectively sponsored an award at UCT in excellence in the built environment. We had our first recipient of that award, a young lady by the name of Barak Ntimba, who has done exceptionally well over her 3rd year, and as a consequence is actually going to be joining us in a couple of weeks in the Cape Town 1-week intensive course program. But also, more importantly, she's doing her honours at the moment and obviously flying there, and she has the freedom of thought of knowing that her finances for that final year of studies are completely taken care of, which is fantastic. And we hope to be the sponsor of many incredible minds coming through the built environment programs at UCT over the years, which will make a meaningful difference to our industry for the future. The final part is the RICS program. We currently have 2 members of staff that are basically going through that program. It's a 3-year program, and the consequence of which is at the end of it, you'll be a fully qualified chartered surveyor with a MRICS certification. And obviously, kudos to the 2 guinea pigs that are going through the system at the moment. Obviously, it's a learning curve for us as well in terms of what we need to provide them to ensure that they get the necessary accreditations from the industry body. Looking ahead, so I think this slide here is quite an important one. I think I think we've shared, and a lot of people have probably been privy to an article that was in the press towards the back end of April with Equitas's intention to potentially look at the selling of what we define internally as our Aviva portfolio. It comprises 5 income-producing assets, and it's being marketed by a leading UK agent. We will have two properties in terms of stabilized properties left in the portfolio, and the intention is probably going into first quarter 26, and we talk about first quarter 26 not in financial year 26, but rather in calendar year 26. So I don't think we're in any rush to sell any of the properties because we feel that the market is actually coming towards us. More importantly, though, the 5 income-producing assets will go through a process, and we should be receiving some bids in the not-too-distant future, following which we will follow a process of streaming that down to probably a short list of 2 to 3 very, very meaningful and serious bidders, and then hopefully being in a process that we can take an offer to our investment committee and board for approval. We remain massively confident that we will probably perform better than book on this. The expectation is to be probably there, but that notwithstanding, our book being a big number, we hope to improve on it. Over and above that, we've got Basingstoke, which got a planning approval towards the back end of last year, and we are basically awaiting the signature of the 106, which will then lead us into judicial review. We're confident that the discord that may have been around in the air with our neighbours in the greater Basingstoke area has certainly calmed down post the successful planning, and we hope to work very meaningfully with the local communities to ensure that as the development becomes viable and the development actually starts, that we create as little disruption to the neighbours as we possibly can, which obviously is always an important consideration in these things. Coton Park, which is one of the properties that was in the joint venture, has now been signed with JD.com, a leading e-commerce retailer, but it's not for their direct use. They do have a property arm within their organization, and this is basically going to be going onto site from the beginning of June, with a delivery date probably towards the back end of 26. Expectation is somewhere in November 26. The consequence of which, again, this talks to what Leila spoke about earlier, that although we've written down certain aspects of the Newlands joint venture, in this instance we will be able to write up a small bit of profit back to balance sheet as and when this gets concluded. We have the 3 companies that we call as the subsequent sale companies, and we are expecting to receive our £1.5 million at the end of June 25, and that is all on target and planned, and that won't change. We further have Thrapston, which is a 2 million square foot scheme, which is going to a planning determination in September 25, and should that be successful, we are expecting that the drawdown on that particular piece of land will probably happen between April and May next year, and the consequence of that is that it will be a further £3.5 million effectively being paid to Equites as part of that process. And then the final part is the practical completion on Newport Pagnell. I mean, Leila spoke to the Panattoni deal. Building number 1 is complete. Building number 2 is fast approaching completion. The final element of the practical completion will be the road infrastructure, which will be enhanced all around the facility, which will be the final cog of the wheel, which should be completed effectively in November 25. Everything is on target for that, and the consequence of which is we will receive our final check in that. In summary, if we were to take all of this into consideration, I think it would be realistic for Equites to expect us to be probably out of the UK in all its facets by the end of calendar year 2026. The process, especially out of the Newlands transaction, but not just the Newlands, also in the stabilized asset transaction, is that our balance sheet is in a very, very strong position at the moment, and we will undertake the sales and the necessary deals in a way that obviously maximizes Equites value. And this is very important to us. We do believe that we are in the beginning phases of a new run in the UK, and we hope to benefit from that with significant new capital being made available to execute in this market. And again, this talks to the deep levels of capital available in the UK. So this takes us to SA. The consequence of what will happen probably in the UK in the next 18 months will result in a significant repatriation of funds. We continue to participate in numerous RFPs within SA, notwithstanding that the quantum of money coming back obviously will necessitate an elevated level of deployment. As a consequence, we are potentially going to start looking at the unlock of value in more multi-let parks in SA. And this will be done on a basis that we will probably be obligated to reduce the spec within these parks, and that will allow us to probably achieve slightly higher yields. The parks obviously will become significantly more property management intensive, but ultimately what they will do is that they will also benefit from increases in short-term rentals. We'll start feeling the effect of those in these parks in the short term rather than in the long term, which is what we're seeing with our stabilized South African portfolio. We see this as a dislocation which potentially will enhance DPS in the short and medium term, and obviously can be carried by the deep weight of the whale and the underpin of the Shoprite portfolio within the business. We continue to see supply chain optimization. We get called into many meetings and have significant conversations with more and more operators, and this is both in the FMCG market, in the retail market, and also in the e-commerce market. Ultimately, it is becoming more and more apparent that investing in this is becoming more and more important, and we're seeing it with the leading retailers having invested significantly in this. And in our example, obviously, you know, Shoprite and Spar and TFG being significant components to our development platform over the last couple of years. What is that doing though? It's putting pressure though on their suppliers. So what we're seeing is that, you know, it's all fine and well that you build an optimal facility to distribute into the final consumer, but if your supplier is not optimizing their supply chain, it also will create a dislocation which needs to be tapped, and we are seeing massive opportunity in that segment of the market where a lot of these suppliers will need to upgrade their facilities, which they probably haven't looked at for the last 10 to 15 years in order for them to meet the requirements of their clients. And then I think our final slide, and really talking to the strategic focus of the organization. We remain obviously committed and see ourselves as a leader and innovator in the large distribution and e-commerce facility. The IP that we have internally and that we've built up with our professional teams and the contractors that continue to support us and provide us with fantastic pricing, but also immaculate building practices, which certainly have a massive impact on maintenance over time. Something built poorly up front leaves legacy problems forever. Something built well and thought out up front, really does mitigate maintenance. And whilst, a lot of shareholders may say, yeah, but why do you care? Maintenance is something you pass on to your tenant. And that is a very factual statement. Notwithstanding that, it still remains a grudge thing. And in order for us to maintain really positive engagements with our tenants and get repeat business from our tenants, having a lot of thought process in that is absolutely critical to creating positive, forward-looking relationships. Logistics Park effectively are there also to counter security issues, which in some instances are becoming bigger. The consequence of that, it's just one added component which allows clients to house their employees in safe nodes. Especially the international companies place massive influence on that decision-making process, and obviously that is a key component of what we do. The intention of the organization, and we've spoken about the flight path to get the balance sheet right. We've spoken about the disposable program. We've spoken about the asset management in terms of increasing rentals and getting sustainable rental growth. Ultimately, it all feeds into one thing, and that is to generate sustainable distribution growth. And what Equites' intention is to create a portfolio that can afford its shareholder a real safe pair of hands that we are able to give above CPI distribution growth to shareholders for many, many, many years to come. And really this talks into the final element there, which is that, DPS guidance for the year is 5 to 7%. We are obviously really pleased that we are going to be entering a new phase of growth again within our portfolio and our business. And then the final part of that, obviously, which goes with that, is the 100% payout ratio. As I said, early doors, there has been a massive rumor mill over the last couple of years in terms of us paying out 100%. We are committed to doing that. The nature of our portfolio allows us to do that, and we will continue to do that for the foreseeable future. So, in conclusion, I would like to take this opportunity to thank our board, my co-executives, my senior management team, and the rest of the Equites team. I mean, maybe a big call out also to the senior management team that have really had to step up to the plate in the last 2 years, and I think have done so admirably. The last 2 years have not been the easiest years in Equites' life, and obviously after 8 years post-listing of massive growth, the last 2 years have forced us to look inwardly and refocus on our business. I think we've done incredible work over the last 2 years, and I think we've positioned the organization that, notwithstanding the external shocks that can come from time to time, of which we have no control, that this business has basically been built to sustain a commensurate risk-reward return for shareholders going forward. And I'm very proud of the entire Equites team and Equites family, and the organization that we've built up over the last 11 years. And I think the next 11 years will certainly be significantly more successful than the last 11. And on that note, I'd like to thank you all for having listened in. And I think we're going to go over to a bit of Q&A. I think there's quite a few questions there, Leila. I hope we have time for them all. And if we don't have time to answer them all, those of you that have answered, we will get back to you online. So I'll defer to you.
Thank you. So I think to start, I've lumped together a few questions, and there's a lot of questions around Basingstoke. So people want to know Basingstoke planning permission, and then also what we expect to do with Basingstoke, or if it's too early to share, and then a question on just where do we find Basingstoke on the balance sheet. So I'm just going to start with that. Basingstoke is included as trading property on the balance sheet. Also, there was a question around how much interest is capitalized, which I think I did answer already, 57 million relating to Basingstoke. Andrea, do you maybe just want to take away?
Yeah. I mean, on Basingstoke, I think the key metric is that there is value in the spade-ready land, and the notwithstanding the fact that we do have planning approval, which was the first major hurdle, we are still not spade-ready on the piece of land. That being said, you know, we talked about the 10-year gilt and the reduced amount of speculative development that's happened in the UK in recent years. I think that pent-up demand potentially is growing and sort of leading into the rest of this year and into next year. I think the quantum of people that would be available to make an acquisition of a site like Basingstoke from Equites Newlands joint venture would be significantly more. That being said, we do want to take the site and get it spade ready. What does that mean? We need to get the 106 done, all the planning to be dispensed with, the planning requirements to be dispensed with. What we need is what they call the 278, which is all the infrastructural costs that will need to be done, to be approved, have the way leaves ready so that we can actually start implementing all those things and effectively allow someone who's buying the site to actually walk onto site immediately. And that is what Equites, with the assistance of Newlands, is aiming to do. And we are certainly on the way to doing that. And as I said, the engagements with the local communities have certainly improved dramatically from pre-planning to post-planning. And we hope to work constructively with that local community to bring facilities to the local area, but more importantly, jobs to the local area. And Basingstoke really is the first footprint of a much greater scheme that Basingstoke Council has for the local area. So it is also in the municipal body's interest to actually see us get going and start bringing some meaningful development to the area. So I think all in all, patience is a virtue, it has been a long journey, and we do understand that you know, some of the shareholders have sort of feel they're a bit long in the tooth on the Basingstoke thing. Unfortunately, the reality of planning in the UK and the risks associated, I think, are highlighted in full view in something like Basingstoke. I mean, there are examples where, unfortunately, some people have gone this full journey that we've done in Basingstoke and still not got planning. So we count ourselves to be on the right side of the curve, and we will at the appropriate time be able to announce something meaningful which will create some shareholder value.
Thank you. The next question, and again, I'm grouping together two questions, but Meyer wants to know on the HSBC and Aviva portfolios, how strong has the interest been, indicative pricing relative to book, which I think you spoke about, and then will there be a CGT impact? I'll take that one. And then have we factored a successful disposal into FY26 forecast? So and Nazim was asking a similar question about whether we've taken it into the forecast. So yeah, you want to start?
Okay, so I mean, in terms of the interest has been significant. So I think we've had more than 30 parties look at it. We would like to isolate that down to probably, and again, I may be speaking out of turn here, and the team at Acre will probably lambast me for this afterwards, but we're probably looking to streamline that down to no more than 6 or 7 participants post the first round, and following which I think we'll go through a process of inspections of the properties. I think some breaking news of yesterday, which is obviously quite positive as well, is that the Every facility, which is in the portfolio, and it's a pretty substantial sort of facility in the portfolio, there's some breaking news from yesterday that it would seem that DHL are in the process of taking out Every, obviously, which will certainly enhance the covenant strength of the facility, which is something that a lot of the shareholders the potential buyers of the facility will be looking at very keenly. So obviously it's not a done deal and we'll need certain regulatory approvals, but obviously every little bit sort of helps in the process. So we are confident that the pricing will be strong, and that the counterpart on the other side will be a counterpart of very, very, very deep pockets, which gives us a lot of confidence that the transaction will actually materially happen.
We envisaged it being a share sale transaction. Also, even if it was a property transaction, in the UK, base costs were reset at 1 April 2019. So we don't envisage there being a massive capital gain, if any at all. And then just in terms of the forecast, included in the forecast, we have assumed transfer of the HSBC assets. But again, as Andrea said, that will only happen in the beginning of FY26, or sorry, the beginning of calendar year 2026, which means that the impact in our FY26 will be really tiny. And then the reason we have a range is, I guess, that from the Aviva portfolio perspective, again, we've factored in both scenarios. And again, the full impact won't be felt in FY26 because this will only happen in the second half of the year. But we have taken into account both scenarios, and that's why we're providing you with a range in terms of guidance. Okay, and then I think we have time for one more question, just from a strategic perspective. Again, I'm going to lump two together. With the proceeds from the UK disposal, should it conclude, would you consider acquiring any other listed funds or private players in South Africa in the next 5 years? And then secondly, once we have exited, are we considering other jurisdictions, or are we happy to focus on South Africa 100% in the short term?
So I mean, from an acquisition point of view, we always looking. You know, the challenge obviously is to get commensurate property at the commensurate value. So that is the first challenge. So in terms of corporate activity, I mean, you know, it will be. There's been a couple of ideas bandied out at our executive level. However, I don't think anything meaningful is possible with any sort of counterpart in the marketplace at the moment that would be enhancing to the Equites shareholder, whilst also giving whatever other organization's shareholder a meaningful positive outcome. Those things can change. I think having such a strong balance sheet as a consequence of this sale would put us in a position of great strength, and we will continue to investigate all opportunities that make sense to ensuring that we remain strategically focused to what our essence and what we do, and what we do very well. Other jurisdictions. I think the UK worked really well for us for two reasons. The first one, obviously, is that we, as a management team, we had insight into the marketplace already, so our ability to go there was not as a complete unknown. During the process of Brexit, we did investigate other jurisdictions. The board felt that, you know, should Brexit be catastrophic, you know, should we be investing in the UK? We did quite a bit of work on various jurisdictions. I think the one we did the most work on was the Netherlands. We probably missed the boat there. By the time we were looking at the Netherlands, the pricing in the Netherlands had become very, very tight. That obviously being a great jurisdiction for especially e-commerce, with 17 million people living in a very densely populated area. That being said, you know, the process for us to make a meaningful decision would require the ability to invest in jurisdictions that afford predictable and sustainable income growth over time, that allow us to create a narrative which feeds into our distribution per share offering that we've got, and coupled with that also offer us a net asset value appreciation in terms of the product that we put on the table. Now, with where interest rates sort of went to in the UK, and with the 5-year rent review mechanism, the UK the low interest rate environment allowed us to grow the portfolio to a size. Unfortunately, we were not able to get that portfolio to what we felt the billion pound mark was where we needed to get to as a consequence of market conditions changing. Had we got the portfolio to that size, we would have had sufficient lease negotiations in every calendar year to sustain that investment over time. The unfortunate reality is that we were in a position where we had rental growth over a period of maybe 2.5 years of that period of 5 years, where we were going through all our rent reviews as we've had in the last couple of years. And part of the reason that we're looking at disposing of it is that apart from and DHL Leeds, every single one of the properties in the portfolio has actually gone through rent review and has seen a significant growth. Now, do we foresee 40, 50, 60% growths in rentals again in the next cycle? Categorically, the answer is no, we don't. We see those rental growths stymieing back into a more normal pattern, if you like, and hence the carrying cost for 5 years is no longer going to be rewarded as an investment in a South African property. So are we looking at other jurisdictions? We always looking, as I said, we studied a few other jurisdictions apart from the one that I mentioned earlier. We continue to study them. I think it's important that as a management team, we debate these things and see if there are opportunities. But as things stand today, as our board stands today, we are committed to investing that money in SA for the time being, but with an open mind to anything that may come in the future.
I think that's all we have time for.
Is that all we have time for?
Yeah.
Awesome. Thank you, everybody. It's been obviously a massive pleasure to deliver these numbers to you all, and we look forward to engaging with some of our bigger shareholders in the next couple of weeks in our one-on-ones. And may you have a fantastic day further. And thank you. Bye-bye.